Hello, everyone, and welcome again to Dollars with Sense. I'm your financial guru, Ella Lang, and I'm here with my fellow financial guru, Terence Vanderwood.
Hi, Ella, and hello, everyone listening to the show, which week after week brings you immense detail and knowledge around helping to grow and protect your wealth. Ella and I are experts in our field and are grateful to have you, our listeners, for giving us your attention over the next half an hour. This week, we will be discussing social responsible investing, or SRI.
And it's also known as sustainable, socially conscious, green, or ethical investing. It's any investment strategy which seeks to consider both financial return and social good to bring about a social change. In general, socially responsible investors encourage corporate practices that promote environmental stewardship, consumer protection, human rights, and diversity. And the areas of concern recognized by the SRI practitioners are sometimes summarized under the heading of the ESG issues. That's environment, social justice, and corporate governance.
Socially responsible investing is one of several related concepts and approaches that influence and in some cases govern how asset managers invest their portfolios or your money. The term social responsible investing sometimes narrowly refers to practices that seek to avoid harm by screening companies included in an investment portfolio. However, the term is also used more broadly to include more proactive practices such as RI, responsible investing, as opposed to SRI, which is socially responsible investing. So it's going to be very confusing between the two, but we'll get more into RI later on this episode. The origins of socially responsible investing may date back to the Religious Society of Friends, or the Quakers. In 1758, yes, all the way back in 1758, the Quaker Philadelphia yearly meeting prohibited members from participating in the slave trade, or buying and selling of humans.
One of the most articulate early adopters of SRI was John Wesley, who in 1703 lived from 1703 to 1791, was one of the founders of Methodism. Wesley's sermon, called The Use of Money, outlined his basic tenets of social investing. For example, not to harm your neighbor through your business practices and to avoid industries like tanning and chemical production, which can harm the health of workers. Some of the best known applications of socially responsible investing were religiously motivated. Investors would avoid sinful companies, such as those associated with products such as guns, liquor, and tobacco.
The modern era of socially responsible investing evolved during the political climate of the 1960s. During this time, socially concerned investors increasingly sought to address equality for women, civil rights, and labor issues. Economic development projects started or managed by Dr. Martin Luther King, like the Montgomery bus boycott and the Operation Breadbasket Project in Chicago, established the beginning model for social responsible investing efforts. Dr. King combined ongoing dialogue with boycotts and direct action targeting specific corporations. Concerns about the Vietnam War were incorporated by some social investors too. Many people lived during the era remembering the picture in June 1972 of a 9-year-old girl running towards the photographer screaming, her back burning from the napalm dropped on her village. That photograph channeled outrage against Dow Chemical, a manufacturer of napalm, and prompted protests across the country against Dow Chemical and other companies profiting from the Vietnam War.
SRI had an important role in ending the apartheid government in South Africa. International opposition to apartheid strengthened after 1960 Sharpeville massacre. And due to mounting political pressure, cities, states, colleges, faith-based groups, and pension funds throughout the U.S. began divesting from companies operating in South Africa. In 1976, the United Nations imposed a mandatory arms embargo against South Africa. From the 1970s to the early 1990s, large institutions avoided investment in South Africa under apartheid. The subsequent negative flow of investment eventually forced a group of businesses representing 75% of South African employers to draft a charter calling for the end of apartheid. While the SRI efforts alone did not bring an end to apartheid, it did focus persuasive international pressure on the South African business community.
Since the late 1990s, SRI has become increasingly defined as a means to promote environmental sustainable development. Many investors consider effects of global climate change significant business and investment risk. SARAS was founded in 1989 by Joan Bavaria and Dennis Hayes, coordinator of the first Earth Day, as a network for investors, environmental organizations, and other public interest groups interested in working with companies to address environmental concerns.
Drawing on the industry's experience using divestment as a tool against apartheid, the Sudan Divestment Task Force was established in 2006 in response to the genocide occurring in the Darfur region of the Sudan. Support from the U.S. government followed with the Sudan Accountability and Divestment Act of 2007, and healthy working conditions, fair wages, product safety, and equal opportunity employment also remain headline concerns for many social investors. In the mid-2010s, some funds developed gender lens investing strategies to promote workplace equality and general welfare of women and girls.
Government-controlled funds, such as pension funds, are often very large players in the investment field and are being pressured by the citizenry and by activist groups to adopt investment policies which encourage ethical corporate behavior, respect the rights of workers, consider environmental concerns, and avoid violations of human rights. One outstanding endorsement of such policies is the Government Pension Fund of Norway, which is mandated to avoid investments which constitute an unacceptable risk that the fund may contribute to unethical acts or omissions, such as violations of fundamental humanitarian principles, serious violations of human rights, gross corruption, or severe environmental damages.
In Scotland, many pension funds are currently under pressure to disinvest from the arms company BAE Systems, partially due to a campaign run by the Campaign Against Arms Trade, the CAAT. Liverpool City Council has passed a successful resolution to disinvest from the company, but a similar attempt by the Scottish Green Party in Edinburgh City Council was blocked by the Liberal Democrats.
Oh, those Democrats. Socially responsible mutual funds counted by the 2014 Trends Report increased in number to 415 in 2014, up from 167 in 2001. The overall number of mutual funds incorporating environmental, social, and corporate governance, or ESG, has increased fourfold since 2012, according to the 2014 report on U.S. sustainable, responsible, and impact investing trends. Among separate account managers, 214 distinctive separate account vehicles or strategies with $433 billion in assets incorporated ESG factors, that's environmental, social, and corporate governance factors, into investment analysis.
Community investing, a subset of socially responsible investing, allows for investment directly into community-based organizations. Community investing institutions use investor capital to finance or guarantee loans to individuals and organizations that have historically been denied access to capital by traditional financial institutions. These loans are used for housing, small business creation, and education or personal development in the U.S., or are made available to local financial institutions abroad to finance international community development. The community investing institution typically provides training and other types of support and expertise to ensure the success of the loan and its returns for investors.
Community investing grew almost 5% from 2012 to 2014. Assets held and invested locally by community development financial institutions based in the U.S. totaled $64.3 billion at the start of 2014. So how do we manage to make the returns while keeping with the ESG factors? That is a big fear of many investors. Social investors use several strategies to maximize financial return and attempt to maximize social good. These strategies may satisfy the ethical principle of non-harming, but with the exception of shareholder activism/engagement, they do not necessarily create positive social impact.
Negative screening excludes certain securities from investment consideration based on social and or environmental criteria. For example, many socially responsible investors screen out tobacco company investments. The longest running SRI index, it's called the Domini 400, was started in May 1990. It has continued to perform competitively with average annualized total returns of 9.51% through December 2009, compared with 8.66% for the S&P 500.
Wow. Despite this impressive growth, it has long been commonly perceived that SRI brings smaller returns than unrestricted investing. So-called sin stocks, again going back to the religious roots, including purveyors of tobacco, alcohol, gambling, and defense contractors, were banned from portfolios on moral or ethical grounds. And shutting out entire industries hurts performance, the critics said. However, in a comprehensive study, financial economists playing the devil's advocate answer the question whether to invest in a socially responsible way or not. They created a set of 755 global and domestic quote-unquote sin indexes consisting of publicly traded socially irresponsible stocks around the world belonging to those 7 deadly sins: adult entertainment, alcohol, gambling, nuclear power, tobacco, and weapons. Wait, there's one missing there. You could make up the last one. They compared their stock market performance directly with a set of socially responsible investment indexes with comparable virtue. They found no compelling evidence that ethical and unethical screens lead to a significant difference in their financial performance, which is in contrast with the results of prior studies on sinful investing.
Positive investing is the new generation of socially responsible investing. It involves making investments in activities and companies believed to have a positive social impact. Positive investing suggests a broad revamping of the industry's methodology for driving change through investments. And this investment approach allows investors to positively express their values on corporate behavior issues such as social injustice and the environment through stock selection, without sacrificing portfolio diversification or long-term performance.
Positive Screen pushes the idea of sustainability, not just in the narrow environmental or humanitarian sense, but also in the sense of a company's long-term potential to compete and succeed. In 2015, Morgan Stanley conducted a review of 10,000 funds and concluded strong sustainability investments outperformed weak sustainability investments, tackling the idea of a trade-off between positive impact and financial return. While the Global Impact Investing Network's 2015 report on benchmarks and returns in impacting investing in private equity and venture capital found market rate or market beating returns were common in impact investments.
Socially responsible investing is a global phenomenon. With the international scope of business itself, social investors frequently invest in companies with international operations. And as international investment products and opportunities have expanded, so have international SRI products. The ranks of social investors are growing throughout developed and developing countries. And in 2006, the United Nations Environment Program launched its Principles for Responsible Investment, which provides a framework for investors to incorporate environmental, social, and governance factors into the investment process. PRI has more than 1,500 signatories, managing more than 60 trillion US dollars of assets.
That's a lot of zeros. And one of those signatories, I'm very happy to say, is Investors Group, who joined on only a few years ago as a present for me for my 45th birthday. Did you know that?
No way.
Yes, indeed. The date was, in matter of fact, May 27th, 2014, when I turned 45. But no, of course, they had no idea it was my birthday. A pretty cool discovery for me, though. So, what is RI, or responsible investment? Responsible investment is an approach to investing that aims to incorporate environmental, social, and governance, so ESG factors, into investment decisions to better manage risk and generate sustainable long-term returns.
Okay, and why invest responsibly? The global momentum, as we've discussed around responsible investment, is driven by recognition in the financial community that ESG factors play a material role in determining risk and return. It also is the understanding that incorporating ESG factors is part of investors' fiduciary duty to their clients and beneficiaries. Investments in this have gained momentum because they're concerned about the impact of short-termism or company performance, investment returns, and market behavior. There are legal requirements protecting the long-term interests of beneficiaries and the wider financial system. And there's pressure from competitors seeking to differentiate themselves by offering responsible investment services as a competitive advantage. Beneficiaries are becoming ever more active and demanding transparency about where and how their money is being invested. And value-destroying reputational risk from issues such as climate change, pollution, working conditions, employee diversity, corruption, and aggressive tax strategies in a world of globalized and social media.
What are environmental, social, and governance ESG factors? So we're going to define the factors a little bit. So examples of ESG factors are numerous and ever shifting. They include, from the environmental side of things, climate change, greenhouse gas emissions, how much a business puts out, resource depletion, like including water, waste and pollution, and deforestation. From the social factors that are measured are working conditions, including slavery and child labor, local communities, including indigenous communities, conflict like war, etc., and health and safety, and finally, for the social factors, employee relations and diversity. From the governance perspective, the factors that are taken into consideration is executive pay, bribery and corruption, political lobbying and donations, board diversity and structure, and tax strategies.
Is responsible investment the same as socially responsible investing or impact investing? Well, no, it's not the same. In touching on these themes, including environmental issues, social issues, and sustainability, responsible investment does have similarities with such investment approaches as socially responsible investing, as we've discussed, impact investing, sustainable investment, ethical investment, and green investment.
Crucially, however, while these approaches seek to combine financial return with a moral or ethical return, responsible investment can and should be pursued even by the investor whose sole purpose is financial return, because it argues that to ignore ESG factors is to ignore risks and opportunities that have a material effect on the returns delivered to clients and beneficiaries. Also, many of these investment approaches target specific themes, such as focusing solely on environmental issues, where responsible investment is a holistic approach which aims to include any information that could be material to investment performance.
Is responsible investment about screening and divestment? Well, responsible investment does not require ruling out investment in any sector or company. It simply involves including ESG information as part of investment decision making to ensure that all relevant factors are accounted for when assessing risk and return. Exactly how an investor incorporates what they have learned from ESG information into their investment practices varies widely, but it can include integrating ESG information into quantitative and qualitative analysis, engaging either individually or alongside other investors with investee companies and entities, engaging either individually or alongside other investors with investee companies or entities on the ESG factors identified as relevant to them.
Also using shareholder voting rights to influence company behavior, encouraging investee companies, entities to disclose information on the ESG factors that do or could affect them, monitoring overall ESG risk within the portfolio by, for instance, by measuring the portfolio's carbon footprint, contributing to the shaping of investor-relevant public policy, promoting wider acceptance and use of responsible investment within the investment industry.
Does responsible investment mean using themed funds and green bonds? Responsible investment does not require the use of specialized products. It's primarily about bringing additional data and analysis into existing approaches. Tailored products whose remit overlaps with areas with responsible investment, such as environmentally or socially themed funds, green bonds, or social impact bonds, can form part of a responsible investment strategy.
So how does one go about to make sure their investments are not only being wisely invested, diversified, and helping to create sustainability? The first step is to talk to your financial advisor about their PRI, or Principles of Responsible Investing status. You can also go to www.unpri. For those of you who are on the podcast, it should be up on your screen now. If you're listening on the radio, then it's www.unpri.org/signatory-directory, where you will see all the signatories around the world and here in Canada.
Your to-do item for this week is to find the company that you invest with and see if they are a PRI partner. If they are, then you can talk to your financial planner about it. If you do not currently have a financial planner, well, luckily we have the answer for you. You can reach out to us. We'll be sure to find you a great financial planner. You can reach us in a variety of ways. Let's start with email. That is the email address 2financialgurus, the number 2, financialgurus@gmail.com. You can always phone us. That's an easy number. 778-879-0820. So give us a call. You can check out our Facebook page that's entitled Dollars with Sense. And you can like us and follow along. Or the best way and the most interesting way is to watch our podcast, listen to our podcast on the YouTube channel, where you just have to type in Ella and Terence into the YouTube search bar. And you'll find us at the top of the list there. Check out our 38 other episodes at your leisure. And if you subscribe to the channel, you'll automatically be notified when a new episode is ready for your listening pleasure.
Thank you for tuning in today and joining us on this episode of Dollars with Sense. We hope you have found it to be useful, and we look forward to seeing you back here next week for another knowledge-packed episode. Until then, Ella and I hope you have a productive week, and may your dollars and cents be with you.